You're listening to the Generational Wealth Through Commercial Real Estate podcast. Your host, Will Smith, is a former NFL player that found his passion in commercial real estate. Every week, you will learn from industry experts everything you need to know to get started investing in commercial real estate to build generational wealth.
Hey, today's guest is Dino Pierce. Dino Pierce is the CEO of Edified Equity, an independent sponsor firm offering deal-specific direct investments serving the affordable housing demand in the southeastern U.S. He's an active multifamily investor, and he comes from a family of entrepreneurs. He's also an active blogger on Bigger Pockets. He has an award-winning blog, so go look it up. And he's also the host of Edified Equity Podcast, and you can find it on iTunes and on YouTube. Hey, Dino, man, thanks for joining us today. Tell us a little bit about you, man.
Yeah, thanks for having me. I appreciate the invite.
Yes, sir.
So you did a really good job. Not much more to add there, except I always like to throw in, my favorite part of life is being a father. So I have 3 kids, and again, it's just it's one of the best things about being alive is being their father. So,
right.
But other than that, you hit the nail on the head on the business aspect and what we're doing in the multifamily space.
Right. Good deal. So, are you only focusing on multifamily, or are you in other asset classes as well?
I'm not right now. I would say for a little bit over 2 years now, it has been solely multifamily, only multifamily. I did start out in the single family space and made a full transition, like I say, probably a little bit over 2 years now.
Yeah.
And it's the only thing we're doing. I mean, I get opportunities all the time, but I don't have a problem, staying in my lane.
Yeah.
And I would rather just be really strategic and really strong and really narrow in one area than just, be kind of good at everything. So that is my main focus. And honestly, I don't know what it would take for me to switch that focus, because I really feel that in the multifamily space, especially workforce housing, we have a very long runway ahead of us.
Yeah. I mean, in the workforce housing, there's going to always be demand because you're going to always have that middle class in America, no matter what. So that's definitely a good area to be focusing on. So you said you started with single families, right?
Yeah.
Did you do flips, or was it just some buy and hold? What were you doing there?
Yeah, no buy and holds. It was all on the flipping aspect. So it started out like many people start, I think, when they get involved in real estate. It started out simply selling my contract for a very small but quick profit. But it didn't take me long to realize, as the saying goes, I was selling the cow instead of keeping the cow and selling the milk. Right. So I just put 2 and 2 together really quick and said, look, instead of me, selling you, Willie, this contract for $1,000, $5,000, whatever the profit is. And by the way, it was heavily tax profit at that. Oh, yeah. So when you factor everything in, it just didn't really make a lot of sense. But anyway, I would say, look, you have the expertise. I don't know how to flip a home. You do. You and your crew do all the work. Yep. I'm bringing the contract, and then on top of it, I'm going to lend to save you some hard money points. I'm going to lend about $25,000, so obviously that's usually not enough for the complete rehab, but it gives you a start. No points, simple interest, and we do a profit split on the back end. So that was my, I never take credit for, running a crew and doing a flip all on my own. Everything I do is part of a team, and I really believe in teamwork.
Yeah. That's actually genius, man, that you thought about doing it that way. You don't have to go swing no hammers or knock no walls down. Like, that's the way, right?
It is. And I just partnered with some of the people that I was assigning and selling these contracts to. So I knew they had a solid track record. I had gotten to know them pretty well as well. I'd seen their work. So it was, I didn't even really feel like it was risky partnering with them like that. And then the other thing was, it was my money. So no one else's money except the hard money lender, but that was kind of on their back because they're getting that money from the lender, not me. And we were in such a hot market. Even back then, this is over 5 years ago, I'm going back. Even back then, we're in such a hot market here in Colorado on the single family side that I knew, I just put the pencil to it. I'm like, look, I know I got this under contract. We put in 50,000 in 6 months. We're looking at this much profit. So,
yep. Got you. So from there, you started looking at how you can scale, and that's why you started looking at the multifamily space.
That's correct. Well, not, it's not even that. So I had a friend who was operating as the COO for a large apartment acquisition and asset management firm, which is what we do now.
Yeah.
And he, just as a friend, he had nothing to gain from it. He just said, look, you have a very good business mind. You are trustworthy. You're good with people. You understand how to operate. You really should get out of the single family, because once you do it, you got to find another one. It's like, it's another job. You got to do it over and over and over again.
Right.
He said, I know you're getting killed on the taxes, which is totally true. And he just kept dripping on me for like, I don't know, a year and a half, just kept boom, boom. You should really do this. You should really do that.
Right.
And I woke up one day, and it was almost like, I don't know, he hypnotized me. And I was like, I should learn how to syndicate multifamily and learn the
Right.
business. Right. So I did, and it was all credit to him. But I just guess over time, him talking to me about taxes, cash flow, it's a longer term type of investment.
Yep.
You can do it with a team, which I liked, because that was the other thing he kept telling me is I'm a senior business manager for a corporation. So I already have that full-time business role. Yeah. And he knew that the fix and flip was just pulling more on me. Not to say that, I mean, look, passive cash flow, unless you're a limited partner and you're just looking at the menu and saying, I want to invest in that. If you're on the active side, nothing's passive. Right. But compared to trying to find here in Colorado, trying to find a deal off market that is so under market and needs so much work, we can come in and add value and make a profit. Yeah. It's a totally different ball game, and it's much smarter. And again, like he said, I don't have to do it over and over and over and over. It's much more of a longer game play, which I like.
Right. So you mentioned something there I want to dig a little deeper in. So you're doing a full-time job, and you're also syndicating, on the side as well. Mm-hmm. So touch on that for some people that's listening to this podcast are going to be like, I'm working a full-time job. There's no way I can start investing, or there's no way I can get into the game. Like, so what advice would you give them?
So what I would say is I always tell people I actually have 3 full-time jobs, because I talked about my three little ones. I don't think that because I am a full-time investor as well as a full-time senior business manager for a corporation that I don't have time for them. For me, it's about where are you willing to sacrifice. Right. Sometimes it means a little bit of sleep. Other times it just means working longer hours. And what I've found, especially right now, what's really important is just being super efficient with the time that you do have when you're awake. Because I'm not going to go against science. I did when I was younger and hadn't come full circle with things and really realized. But what I'm getting at is I'm not going to go against science and say you should live off of 3 hours of sleep so that you can do everything you want to do and see your goals come to fruition. That's not healthy. Science says the human body needs rest. Right. And now I'm in that mindset. I said, okay, well, maybe 6, 7, possibly even 8 hours. How productive are you with time management, and what are you doing with the hours that you are awake? So just being really efficient again with scheduling my day has helped me get more accomplished and be there for, like I said, my 3 little ones. But here's what I'll say. It can be done. Yeah. It's, there's other things though. For me, it's not a sacrifice because I don't, it's not for me. So for example, I don't play video games where other people might do 3, 4, 5 hours. And look, if that's what makes you happy and you're passionate and that's like fulfilling you in life, then do it. But I'm sure there's something that everyone listening can say, yeah, you know what? If I did a little bit less of this, I can still get a fulfillment piece from it, but I can probably get more done, accomplished on the goal aspect. And then finally, and then I'll stop and let you go. But here's the other thing. It's a team. On my corporate side, I'm a senior business manager, but there's a team. There's thousands of employees on that team. Right. On the apartment sector side, on the multifamily space, I'm one person that's part of the independent sponsorship team. There's at least on every deal that I've been a part of, at the very least, 3 or 4 other active operators involved.
Right. Those some very good points, man. Really, it comes down to, like you said, you got to have your time management. You need to be really living by a schedule, and then deciding what's important. Like, I mean, is Netflix really that important that you got to binge watch, every night on the show?
Yeah.
You can cut the fat in certain places, man.
Yeah, that's the other thing. I mean, I won't list all the things, but there's certain things, and it's just how I grew up and where I grew up, I think. But TV for me was never important. Like, actually, my kids watch they have a few programs that they like that's educational, but when, I never have the TV on for myself. And having said that, honestly, a good documentary, that's what would pull me in. But I don't have like a show or anything like that. And again, I talked about the video games. So just being more efficient. I'd rather, instead of even football, I would rather me and, Willie, I'd rather you and I go throw the football in a park and spend some time together than sit down and watch it. There's other people though, and I'm not saying that's bad. There's other things that I do that people don't. So it's just a trade-off.
Yeah. Fair enough. So let's talk about how you guys are finding your deals as far as your group. What are you guys using? Is it direct mail, or are you using brokers? Like, what are you guys focusing on to find deals?
Yeah, I think that, I know actually that the best way for an independent direct investment sponsor team to find deals is through broker relationships. Now, having said that, it doesn't mean that I want to go further. Like, in other words, I want to get to the deal behind the deal. You meet a broker usually they have a deal available. You underwrite it, you get back to them with honest feedback. This isn't a game we're playing, because by the way, if that deal worked and we won, the offering process, so we had the best bid and all that, we would move forward with it. So I'm not encouraging people to play a game with other people. But what I am saying is, if I can get to know that broker and gain their trust and show the track record of what we've closed, and they say, okay, this group is a real player, I want to get right above their A-list, to where when they send us an opportunity and I say, hey, so-and-so, so how many, we like that market, it's the right number of units, it's the value add, everything we want, how many people are underwriting this? If they say 5 or less, or 3 or less, or even better, they say, Dino, you guys are the only ones taking a look at it, so please get back to me like within 48 hours, something like that. That's what we want. But if it's on, obviously, we don't even look at LoopNet. And look, if you want to sift through enough, I'm sure I know there are deals on LoopNet. It's just not, it's not the game that we play. We want to build strong relationships and get either true off market or very pocket listings. And then the other way is through our existing property management companies, because they get word of mouth. They're managing for other operators. They want to keep the business. So they might, if they say, hey, we're looking to sell, I know this great group right down the street that own 100 units. Would you like to talk? That's another great way. And then finally, we are experimenting right now with some possible like pre-foreclosure, maybe HUD, things like that, but nothing has come to fruition. It's a very new process for us.
Right. Now, I just want to touch on real briefly on your broker relationships, because I know some listeners are like, okay, so you talk to the brokers, but how do I get them to take me serious? So, you mentioned going and talking about properties and, really maybe walking through some properties, but as far as the relationship side of it, like, what are you doing to make sure you get to the top of the list? Like, what are some actual tactics you're using?
You named it. So my partner, and just to be clear, while I do a lot of market analysis and underwriting behind my partners, I am not the main acquisitions person, but I know what he does. He's great about, so let's say we had a new market. He would contact them first, send them a track record and say, we are interested in this new market. I've been told by other operators or however that you're the person I need to talk to. He's going to fly out there, walk some properties, meet them in person.
Yep.
And again, that's what goes back to having a team. With me having 3 little ones, being a senior business manager, my schedule does not allow me to be that mobile. His does, which is a great asset to me. And there's things that I bring to the table that obviously he thinks are desirable and help him out. So it's a win-win.
Right.
But that's what he's doing, because even like us, we met through LinkedIn. Now we're having a conversation. I can see you, you can see me.
Right.
Oh, he's a real person. It's like we haven't even physically, we haven't even shook hands, but just having this video conference call and having audio brings the level of how I know you here. Now, if I would have flown to wherever you are and like be in the room on the side of you, it would even be higher. So I know that right there, it gives us so much. Just the simple fact that meeting face to face and walking properties. I mean, we have had where he went out on a brokered call, walked some properties, and they told him, they were basically like, hey, we're actually walking this property for the first time, so just, kind of stay quiet and look like you're with the brokerage. So he really got an inside view and was one of the first ones to see it.
Wow. That's awesome. That is awesome, man. No, I want to talk about something here, man, because I listen to a lot of podcasts as well, and I'm sure a lot of people that's listening right now listen to another podcast or two.
Sure.
You hear people talk about building teams, but nobody ever really talks about who should be on that team and what's the best way to attract that right kind of talent around you. Touch on that for a moment if you can.
Yeah, for sure. So we are, my partner and I, what I consider emerging managers. I mean, you heard me talk about go back 5 years. That was a single family space. A little bit over 2 solid years in the multifamily space. Now, that's an emerging manager. I cannot come on your podcast and say, hey, I have, I'm throwing pretend numbers out there, but X millions in assets under management and over 5,000 doors. It's just not true. Now, having said that, what a good thing that an emerging manager can do, because you're going to need a track record. Like Freddie and Fannie are, while they love writing loans at really good interest rates and amortizing over 30 years and fixing it for 10, 7, all that, they love it. They would say, well, we like that asset class, but have you done a deal? Right. Okay, so what you need to do as an emerging manager is get a really good acquisitions person, and that acquisitions person can be on the team. If it's not you, they can also be emerging, because you can know how to underwrite. That's math. That's it. You can know how to underwrite, not have a ton of experience. But what you will also need is to align yourself with a senior general partner, someone who has 10, maybe 20 years of experience in this space, so that they can. And then you need a liquidity partner. If that general partner is not one, you need someone with the liquidity, so they have the balance sheet to sign on the loan. You need the experience to sign on the loan. You need to know how to acquire assets and have that person that can go out and build relationships. And then finally on your team, because everything that we do is through private offerings, Regulation D, 506, B, SEC exemption. So it's all very, very private. You need to have your network, your team members have to have the relationships with people that have private capital, that are looking for equity, to be limited partners, or come in and be a very strong co-GP or something like that. But that's it. Acquisitions, access to capital, someone who can help qualify for the loan, and that's in 2 areas: experience and then that balance sheet.
So now, real quick, let me just touch on. You mentioned in the syndication of a 506B, and for those that are listening, that means you need to have a pre-existing relationship with them. This can't be something you're marketing for. It has to be pre-existing relationships. But go ahead, man.
Yeah, no, it's very private. You cannot see it on Facebook, LinkedIn, anywhere. And the limitations are unlimited accredited, and then there's up to 35 sophisticated which means they have to, and they can self-certify through an SEC investor qualification questionnaire if they're accredited or sophisticated. Right. Now, we still look at this, and again, we know them. So we've turned people away to where we've said, look, you have the capital, right? But we don't feel that you have enough experience in the multifamily space. So let us educate you and bring you into a deal like a year from now. That's the other thing I didn't talk about, is just having the patience to do things. But before I get off topic, so how do you find them? So I found them through, first, I always tell people, learn the business. Whether you're going to be a passive investor or an active investor, learn the business. Right. You need to know what you're doing. And then in that process of learning the business, I got associated with kind of like a mastermind group. And that's where I met the other key partner, which does the acquisitions. He had relationships from a different mastermind with senior general partners that I was able to leverage. Having the right team, it's all about leveraging win-win-win scenarios. Right.
And this is a relationship business, bottom line. This is nothing. You're not going to go and play this game by yourself. You need some team. You need some players on your team with you. Okay, so when you were first getting started, man, what was like the biggest challenge you faced? Like when you first got out there and you wanted to do your first deal, what was the biggest challenge you were seeing?
It's kind of the same challenge that we're seeing now, which is the first challenge was finding the deal that actually penciled out, because we've had, and we had to really tighten in our mandates to let people know what we were looking for, because I was getting every deal thrown at, that existed under the sun thrown at me. Right. And first of all, if you're going to really underwrite something, I mean, you need to have a way to quickly identify within 10 to 20 minutes whether or not you should dig further. Yep. And you do that by having mandates. Oh, it's not in, for example, it's not in Huntsville, Alabama. I'm not looking at it. It's not 50 units or larger. I'm not looking at it. If it's not over $1 million in purchase price, like I'm not. So you need all those things you have to have right away. Right. But it was finding it. It took, from the time I made the decision to get out of single family and get into multifamily, it literally took almost a year for us to close on our first deal. And that's because, again, of the time these things take longer to close, first of all, but the other thing was just finding the right deal, finding it. And then you don't realize this, but people say if you have the right deal, the money will come. Well, when you're in a 506B and you can't openly talk about that deal, you can only share it with your existing relationship. Then we found out that was the other thing, is we didn't realize, but you should be, through a thought leadership platform, calling your relationships, however, but you should be letting people know way in advance that this is what you are doing, and you're going to need limited partners on the equity side, so that when you have something, you already have at least a list of maybe 10 or more people at the very least that you can call and say, we found one, let me share the details with you.
Right. That's a very, very good point. Now, since we talked about it, you was looking at how you look at your deals and stuff. What are some red flags, when you're actually in the market that you want to be in? Like, what are the red flags that jump off a page that you say, this is not a good deal for us?
For the first thing is crime. Areas can gentrify, and that can take over time, and that's fine. It's okay for them to be developing around what we own, but it's harder to change the people that are living there. And sometimes what has happened in the past carries a stigma, and that can last for years and years and years. So, deaths, crime in the area, that we look for, school zones, how safe they are how high are they rated? What type of retail is around there, like walking distance, amenities, things like that. But the number one thing we're going to look at first, if it's in the market, if it's the right number of units, if it's the value add, we're going to say, okay, wait, stop before we do anything else. What's the crime look like? And we'll go from there. And one of the best things to do, and it doesn't cost any money, and I've done this several times personally,
Yep.
is I call the police department and I ask for a patrol officer that has that area, and they always call you and they give you and I'm straight up with them. Look, I'm part of an investment firm. We're about to buy a $5 million apartment in the area you patrol. Like, help me out. Don't steer me wrong. And they're honest.
Wow, man. I never heard that one. That's a really good tip there, man. For sure.
It's real time. I mean, other than that, you can Trulia has really good, heat maps for crime. And there's other websites and things you can do. But I think hearing it word of mouth, I mean, there's some officers who are like, oh yeah, oh no, I've been patrolling that area. I know that apartment. I've been there 5 years. And no, it's not a bad area. So sometimes that inside information, well, Trulia might be saying, it's an 8 out of 10 on the crime level. And then this officer's like, no. So other people might steer away from it. And that might be something you have to bring up to your equity investors too, because they're going to do their due diligence and be like, man, there's all kind of crime here. Yeah. And then you can say, well, I talked to officer so-and-so,
Yeah. That's very, very good, man. That's a gold nugget there for sure. So as far as the markets right now, what markets are you focusing on, and what's the unit count you're going after?
Yeah, so it's still 50 and above, so 50 units plus. Mm-hmm. And we really like the South. So we like the southern parts of Mississippi. I mentioned Huntsville, Alabama. Louisville, Kentucky. So there's other areas that we're looking. Pensacola, Florida, Little Rock, Arkansas. Those are all areas of interest for us. Again, it's pretty much the South.
Yeah. Gotcha. Now there's a lot of people listening to podcasts, and they say, well, you know what? If they can do it, I can do it too, which is true. But what are you seeing right now as far as, mistakes that these rookies are making? Like, what is the biggest rookie mistake you see people making?
I think the biggest thing is, so first of all, we have to remember that we are investors, and you have to take your ego out of it. If you're emerging and you're just getting started, you really need to lean on the experience of the senior people on your team.
Right.
It's while it might be fun, and again, it's all ego driven for me to come on Willie's podcast and say, I have X million assets under management and X 1,000 doors. That's not the goal. The goal is to get a solid investment. So I would rather take down one really solid deal a year, or every other year for that matter, versus do 10 and then 9 of the 10 I have no business being in, especially when you are syndicating and there are other people's equity and money in the deal. I say this wholeheartedly to everyone. It's trying to go too fast, play the long game. We really do have, I personally know I have at least 30 more years in this space. We're dealing with one of Maslow's hierarchy of needs, which is shelter. Humans, we need shelter. And right now in America, the demand far outpaces the supply in where we are, which is workforce. We don't do luxury. We don't do war zones. So you really need to play that long game. But getting back to the main thing that helps me sleep at night is that everything that I've been involved in over the past 2 years is operating and cash flowing, because we played it smart. We took our time. We said no. We backed out when things didn't work, like all of those. So if a deal, now things go south, even with all the best intentions. So if you and I both invest $500,000 into the same syndication and it went south, here's where my mind would go. Wow, that was an expensive lesson, but I'm very resilient. I'm going to make it back. I'm not worried about me. It's Willie's 500 that's going to literally have me to the doctor with ulcers in my stomach because I'm worried. Even though you signed the PPM, you knew all the risks, it doesn't matter. That is a PPM, a private placement memorandum, and having an equity partner sign it doesn't take the humanness and the consciousness out of doing business together.
That's fair. That's fair, man. It's if I'm talking to a syndicator and they're all about, you know, what they can do, and they're not afraid to lose money, you know, that's not a syndicator I want to be talking to.
No, I mean, their own money, fine, do what you want with it. But
Right.
again, I'm telling you, that's what would kill me if something went south, is not what I have in it.
Yeah.
It's knowing that I willingly brought people in to what I thought was going to be solid, and it didn't turn out that way. And I would have a heart to, I mean, thankfully I've never been in that situation, but
Right.
I would have a serious heart to heart and say, like, we would literally have to have a conversation about obviously what happened, and you know, what did we learn and what can we do to remedy this?
Right.
I think, and that's the other thing too, when things are, because they take twists and turns. I mean, we've had to replace property management company before, but our asset manager, I didn't even say that. You need a really good asset manager, is very important person on the team. So it's not one of the 4 or 5 that I mentioned. Add asset manager to the list, but they caught it quick. We were able to make the changes. I think high level of communication. And that's the other thing that I love so much about this sector versus the stock market or bonds. It's like, all of our investors have access to our cell phones. Many of them have access to me face to face.
Right.
Like, that's such an intimate relationship to have with the people that are in charge of the investment. You can't beat it.
Right. Absolutely, man. That's for sure. Okay, so man, we're going to segue into the next part of the show. It's going to be a deal deep dive. So we want to just talk about one deal you've done that you can remember, and let's see what we can get out of it.
Yeah, sure. So I'll talk about, like I said, all of them are doing well and cash flowing, but we try to buy them that way. We don't do major repositions. Like, we're not going to buy a vacant building. So again, having your mandates in place. If someone brings me, they're like, man, this is in your market and it's $5,000 a door, you know, but it's vacant, you guys have to reposition it. I'm like, that sounds great. Unfortunately, that's not our team. But anyway, we found one that was an under-the-radar market, an under-the-radar area that is really just outperforming our projections. Wow. And of course, we love that, because we underwrite conservatively, so we do want to outperform. But when we, you know, compared to what we gave our investors. But anyway, this property is located in Gulfport, Mississippi. Mm-hmm. And of course, one of the main concerns was hurricanes being that close to the coast. Right. So we had the right insurance policy in place to make all of our investors, as well as us, feel confident. Covers loss of income if something catastrophic would happen. We started to do our due diligence. What happened in Katrina? Because this building is from the 70s. Right. What happened during Katrina? Oh, no flooding. Boom, that's a plus, because if Katrina can't do it, what will? What did happen? There was some wind damage on the roof, and that they had the roof replaced, but that was it. We like that. Then we talked about gentrification. What ends up happening is, right now, literally in walking distance, tons of A and B class retail is being built all around. So we are C by vintage, but located in an B plus, possibly even A minus area. We looked at other things like what's happening. We learned that the port of Gulfport was just approved after the U.S. Army Corps of Engineers did, I think it was 5 years of due diligence. They gave it the green light and said, we're going to expand the port of Gulfport $750 million. We looked at the U.S. Navy had just signed a big contract to build 5 more destroyers. They're building a state-of-the-art, I think it's a $92 million state-of-the-art aquarium. Realtor.com had just put out a report naming the 10 small cities poised to boom, likened to be the next Austin, and we were on the list. I mean, it's like every which way that we looked, and we went very local. When you're looking at a market that, you know, it's not like I said, oh, it was in Austin or it was in Dallas or Houston. Everybody's like looking at those. So we try to identify those types of markets. And then prove to ourselves, once we find the opportunity, we try to talk ourselves out of it. And as we did our due diligence, we're like, we really should have more here instead of.
Right.
So,
And that's a good point that you said there, though, man. I want to touch on that. You didn't look at the deal and say, how can we make this deal work? You look at the deal and say, why doesn't this deal work? That's a very good mindset to have when you're underwriting deals.
Yeah.
Absolutely.
Yeah. And then the other thing, because I didn't mention this again as we talk through the deal, I'm thinking of all my team members and stuff.
Yeah.
But that property management company that we have in place there, is just phenomenal. And they have a development background. They are already operating a similar size in the community.
Yeah.
That's always a little bit of a gamble. So you need to have 2 to 3 backups in case the one you ended up selecting, and those even though the references check out, sometimes just doesn't work, or they don't meet your expectations. But that property management company, even we have different property management companies helping on every asset we own. There's some larger national ones that might do well, but that's a very important part of the success. And they have just worked out for us. We hit a home run with them.
Right. Now, how many units was this, and what was the value add you did on this property?
Yeah, so the units, this was right over 100, 101 doors.
Okay.
So it's not giant, but not small either, like closer to that 50 unit that we look for at the bare minimum. The value add was the operators were self-managing from about 2 states away. And while they were apartment people and a good apartment group, that was just not in their wheelhouse to have it self-managed from far away like that.
Yeah.
So number one was improving the operations with the management company, flat out. The other thing was, as we looked and did our due diligence and double checked with our property management company. So, hey, we underwrote this. We're not even going to share with you what we think the rent should be. We're going to ask property management to underwrite it. And you tell us what that sister property that you also manage, what are you getting there? Like, so much inside information you can get from them. They truly know the market and what can be done. But anyway, so the operations, and then simply doing some light renovations. We had a $2,000 to $3,000 package plan in place for each unit on natural turnover.
Yeah.
But we're also simply just going to push the rent as leases turn. So we're going to do a combination of both. And then we fixed up the playground. They had a chain link fence around the pool. We put a nice wrought iron fence, new full pool furniture, and plants and things like this. So we just started creating a community. I mean, I had a senior operator who has over 30 years, and he touts this 30,000 doors under his belt. Tell me, if you want to keep up with the market, the number one way to increase your rent and stay at that top is to create a community. People don't want to leave a community. When they get to know their neighbors and their kids meet at the playground to play, and they do like after school functions in the clubhouse, like do homework and offer tutoring, take your pooch to the pool days, all pumpkin carving, all this stuff really helped create that community. And look, if you're staying at market or even right below, moving is a hassle. You have a deposit on the line that you're going to have to hopefully get it back. You're going to have to put it into the next place. When you start doing your due diligence and you're like, wow, they're bumping me, but I can stay and still be like $25 under what all their competition is. I'm not moving. I'll pay the $75 bump or whatever it is.
Right. Now that property management company, are they on site, or is it just third party that's in the area?
Yes. So it's third party in the area, and they are, like I said, they were already managing. Their main office is actually, it's a satellite office from a larger company, but they're physically there. And the main office is close enough to where the person who operates the management company is actually physically on site pretty frequently as well. So
okay, good. Now what kind of debt did you put on this deal here?
This was a small business with this was with Freddie. the reason I'm digging in my brain is because we went back and forth and kind of at the last minute ended up going through Freddie. So that was the other thing. We got it locked for 7 years at a really good rate. And then we have a floating at 13, but we're able to get out of it if we want. We're good for 7 years. Yeah. A floating for an additional 13. So we're in a loan, for a solid, large amount of time, larger than our business plan is even saying we're going to stay there. Right. Because ultimately, we're going to sell off of opportunity, not the calendar. That's why we want to make sure we can hold these way longer than the business plan we have in place allows for. So when the market does whatever it's going to do, because it's going to do something, it's a market. So when the market does whatever it's going to do, we're locked in with good debt. We have a good debt coverage ratio. It's still cash flowing. We're making our distributions. And if anything, not that we're struggling at all with occupancy. That was another thing we liked about it. High historic occupancy, like 97 and 98% occupied. So we're going to, if anything, be 100% because when things turn, the luxury people come to the B class. Right. People who get in trouble for unfortunate reasons with homes come to the B, C area. Yep. Yeah. Good stuff, man. Good stuff. All right, so we're going to segue into the last segment of the show, man. It's going to be real quick. It's a lightning round. So, ready for it? I'm ready. First question. What's the best advice you've ever been given? Oh, wow. The best advice I've ever been given is probably my grandmother, who grabbed me at a very young age. I was 11, 12, 13. No, probably more like 11, 12, or 10. Yep. And she said, I told her something I was afraid to do. And she literally grabbed my shoulders, looked me in the square in the eyes and said, baby, you're going to have to overcome your fears. And I think you should go ahead and do, because I was showing her what I wanted to do and I was afraid to do. Right. And I did it after she had that talk with me. And it's a life-changing story. I did what I wanted to do. I accomplished my fear, and it put me in a position seconds later to save a young girl who was drowning. I actually saved her life when I was a little bitty boy. Wow. And from then on, I have always, and even on a lot of my profiles, it has a picture of me on the side. It says, you have to learn to face your fears. So my grandmother, facing your fears. Oh, that's great. That's great advice. Number 2, what is the best book you've read this year? You know what? Actually, this year, let me think. I would say I read, there's a book called The Single Family Office by Richard C. Wilson, who was a guest on my 2 podcasts ago. And I learned a whole bunch from, I'd say the Single Family Office by Richard Wilson is probably the best book that I have read. Yep. But I'm actually more of an audio guy, and I've listened to more podcasts, a lot of Richard's podcasts as well. But I probably, it's not technically a book, but that's where I'm getting my information. Right. Podcasts are huge as well, man. I pretty much listen to those a lot. Number 3, what are some rituals you have created that's making you a better investor right now? I'd say better at life in general is being really structured with my time and knowing specifically when I'm going to sleep, when I'm awake working, what task, what time is there, how am I going to make it all fit, put the family and everything in there. So I think not only as an investor, but as a person, but for an investor side, I'll just flat out say it's patience and no ego. That's it. You wait. I don't care if we don't syndicate a deal for 5 more years. Right. If the deal wasn't in front of me, I didn't do it. Right. Simple. Right. Got you. 4, what is one thing you're doing right now to help you improve your business? The one thing that I'm doing to help improve is really be a lighthouse in educating other people through thought leadership platforms like what you're doing here with your podcast, my blog, the YouTube show. All of that is just patiently giving freely. You couldn't buy anything from me if you wanted. I'm like, oh, I have nothing to sell you. But so I'm just giving quality consultative content regularly. And what happens is if you play the long game, people see that you're genuine and they want to align themselves with you because they know that you have something true and of value to offer. That is one thing. That and patience, again, is what I'm doing.
Right. Okay, last question. If you can give your younger self one tip regarding investing, what would that be?
I would say skip the single family side altogether and start getting into multifamily. Get into multifamily earlier, and here's how you do it. I'm going to have that talk with myself. Here's how you do it. You have no experience. You need to find something of value that you can bring to an existing experienced team of operators, whether that is underwriting deals in their market and bringing them a deal, whether it's bringing your network of capital as well as offering your underwriting skills or your ability to analyze markets. It has to be something else active, but find something, go to that existing group. And I'm telling you right now, most groups need two things, deals and capital.
Right.
So if you can bring that to them, don't go to them and say, I'm young and hungry and I have time. What can I do for you? They're going to be like, I don't know. Like, you tell them what your skill is, and then you show them by adding the value. And last thing is, and by the way, be willing to do it for free. Be willing to show them so much value and that you're not greedy and you have long game goggles on, that they're like, I really like working with you.
Man, that's some great advice there for sure. All right, man. Well, Dino, this is the end of the podcast, man. Tell my listeners, how can they get in touch with you?
I'm super easy to find. I'm active on social media. You just look either Dino Pierce or look up Edified Equity. You'll find me, like we talked about, YouTube, podcast, the Bigger Pockets blog, Facebook. I have a closed Facebook group. Again, it's where we're sharing not investments. There's no pitches. It's like 1,400 plus people in that group. There's no pitching. They're not getting my deals. We can't do that. It's offering the quality consultative content. So I'm easy to get a hold of. Just search.
Gotcha. Well, hey, Dino, man, we appreciate you today, and let's stay in touch.
Yes, sir. Thank you for the opportunity. I appreciate it.
Yes, sir.
Thank you for listening to the Generational Wealth Through Commercial Real Estate podcast, brought to you by Onyx Capital Investments. Onyx Capital Investments works with investors nationwide to invest in income-producing real estate in emerging markets. Connect online at www.onyxcapitalinvestments.com to learn more about what we're doing. If we have added value to your life, please leave us a review.